Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
Hey everyone, welcome to another episode of the 15-Minute Financial Feast. I'm your host, Mark Triplett.
And I'm Troy Westendorf.
And today's 15-Minute Financial Feast will be covering the topic of 6 retirement risks that you should know about. We're going to talk about 6 common retirement risks, how to spot them, and some strategies to mitigate or eliminate those potential risks. I think it's really, really important to identify these and understand the 6 that we see that are most common. What are they?
Yeah, Mark, this is something that we talk to, I guess it'd be our second meeting. We do our analysis meeting. We go through these different types of risks, and they're always something good to talk about, how we spot them, how to deal with them. We can't eliminate them, but we can surely plan for them, and that's what we try to do here. So the first one we're going to talk about today is longevity. That is a risk because life expectations, if we knew how long we were going to live, that would be perfect. We would say, we have 15 years, here's the resources, and we can spend them. But we don't know that, but we do know is that we are living longer. So when you look at the better medical care, better living conditions, these days we have a statistical life expectancy in the U.S. of living about 80 years. So living well into one's 80s or 90s is perfectly realistic. And for many of us, we all know someone who's getting into their 80s for sure, and seemingly really good health, still getting around, still doing things, still golfing, still going to the gym. So we're just living in a time now where we have that life expectancy that is living way more than what we used to be seeing.
Well, the farther you make it, the longer your life expectancy.
Right.
So if you compare the life expectancy to somebody born today, their life expectancy might be 80. But if you look at somebody who's made it to, say age, mid 50s,
right,
their life expectancy is much longer. In fact, according to the Society of Actuaries, I'm looking at one of their infographics here. According to the Society of Actuaries, 1 out of every 2 females that is currently in their mid 50s will live to be age 90. 1 out of every 3 males.
Wow.
So you've got a really significant chance.
Yeah.
If you're 50 plus today and relatively healthy, you've got a pretty significant chance of living well into your late 80s and maybe even into your 90s. And so planning accordingly is important. And longevity, out of the 6 common risks, is the risk multiplier. We cover it first because all of the other risks that follow are magnified the longer you live. So what's the next one on your radar?
Next one we got here is market risk. What is market risk?
Well, let's talk about market risk relative to investment risk. Investment risk, perhaps investing in a single position, single stock, for example.
You want to diversify.
You want to diversify, right? That single position risk is investment risk. So you can diversify that by having a bunch of different positions in different categories and different investments between fixed income, like bonds, for example, and equities like stocks and maybe alternative investments and whatnot. You can diversify against investment risk. Market risk, however, is systemic. Market risk is something you cannot diversify against. An example of market risk might be the dot-com bubble from March of 2020 through really October of 2020, March of 2000 to October of 2002. And actually from the peak to the trough back to break even, it was a 7.5 year period of time before you really got back to break even. Another example would be the subprime crisis in the housing market. It took a lot of folks by surprise, and that was about a 4-year period from peak to trough back to break even. And so these are systemic downturns in the market that you really can't hide anywhere from. You just have to be in a position to be able to ride it out, and maybe even in a position to take advantage of the opportunities presented when this happens. But that's market risk.
So next one in line, we have order of returns risk. So order of returns risk is if we have all of our dollars in that market, say the dot-com bubble or the subprime crisis, all of our dollars are invested in the market. That is an issue when we have order of returns risk because now we have retired, we hit the crisis, we need dollars to live off. We still need dollars to pay our bills. We still need dollars to pay the utilities, the taxes, all that fun stuff, groceries. Now that we're losing value in that account and we're pulling dollars out of that account, how fast does that deplete an account when say we have a market downturn and we still need to access dollars from it?
And this is a hard concept to get your hands around without really visually seeing some sort of demonstration, because general thought would be that the order at which returns occur doesn't really matter. Like if I'm invested in a well-diversified portfolio and the order at which returns happen on an annual basis from over a 10-year period of time, whether I have an order of returns where there are negative years in the beginning and followed by positive years or flip-flop that, the outcome really is about the same. Okay. And we have some cool visuals that we show folks to be able to demonstrate that. However, so that's maybe your accumulation or preservation phase, right? You're maybe 50, 55, maybe you're still contributing to your retirement accounts, but you've contributed quite a bit at this point and they're just kind of accumulating right now. When you transition to your post-working years, you transition into retirement, and your retirement assets start to support your lifestyle to replace your paycheck that no longer is coming in because you're no longer working. You're now distributing those assets. Now the order at which returns occur can result in either A, you living in abundance, or B, running out of resources much more quickly than expected. And it all comes down to, do I have negative returns early in retirement, or do I have positive returns early in retirement? And the order at which those occur can have a huge magnification as to whether I live in abundance or whether I run out. And that's really hard for folks to get their arms around until they start to see the math involved in that. And I think there's some really great visual tools if people are interested in seeing how the sequence of returns actually can play out and why this is a risk that needs to be mitigated. You can do a quick Google search and probably find some cool stuff, or you can reach out to our team here at Triplett-Westendorf Financial Group, and we can send you some content on that. But I think it's a really important risk to understand and one to mitigate if you're not right now doing anything.
Absolutely.
So.
It's definitely eye-opening to see it, to see how that actually works and to see the impact that can have on a plan. All right. Next one up, taxes. This is always a fun one. I'll let you talk about taxes, Mark. I know we have the Trump Tax Cut and Jobs Act that's going to expire at the end of 2025, if not sooner. How do taxes affect a plan? And this is another thing, when you see it on paper or you see it once we do a plan and put it up on the screen and can kind of show them the numbers of here's what it does to your plan versus not doing anything about it at all, has a big impact.
So I think taxes are one of the two major drivers that result in people spending more in retirement than they expected. And I think the primary reason for that is, we work with a few business owners, but most of our clients are W-2 employees. Mm-hmm. They work for somebody, they trade their time and expertise for an income, and whether they work for a corporation or whatever. And they receive this income coming into their bank account, and that really helps shape their lifestyle, where they live, what they drive, where they go on vacation, where their kids go to school, all of these things that kind of are shaped based off of that income stream coming into their household. And hopefully over time that goes up. They become more valuable in the marketplace. They get increases in income. But they're receiving this income into their bank account after health insurance has been deducted.
Yep.
And after taxes have been deducted. So when they make the transition out into from the workforce into retirement, and now they're going to start drawing off of their retirement accounts in order to maintain their lifestyle. Most folks today have saved primarily into pre-tax retirement accounts, IRAs, 401ks, and other IOUs, the IRS. And what they fail to to realize until they start making distributions is that they didn't save taxes, they deferred taxes on those accounts. So every time they make a distribution from their IRA or other IOU to the IRS, they're going to have to pay taxes.
Exactly.
And the larger the distributions, the higher the effective tax rate you pay. And so just to maintain their lifestyle, taxes start chipping away at their retirement resources because they have to spend more to keep up with the rising cost of goods and services. Ideally, somebody going into retirement would have done enough planning up front to have money in pre-tax accounts like IRAs, enough money in never taxed accounts like Roth IRAs, and some money in after-tax accounts, like brokerage accounts that are taxed at capital gains tax rates and even savings that are 1099 and things like that. Anyway, and be able to blend those out so you can keep your effective tax rate lower. A lot of the folks that we meet have done very little planning with regard to this. They've just been encouraged to keep deferring taxes, whether it was their CPA, the HR department, or their financial advisor telling them to defer taxes. And now they're in for a shocker because almost 100% of their income in retirement is derived from distributions from pre-tax accounts, and their income really doesn't go down. And now they have to account for taxes on those distributions. So they end up spending more in retirement than they thought. And if we can reduce the impact of taxes by doing some strategic planning up front, we can give them more control and oftentimes make their resources last longer. Taxes is one of those things that we can't eliminate and we can't predict, but we can try to mitigate it to the best of our ability.
Absolutely. Another one here that we can't predict or eliminate is inflation. And we talk about that as well when we go through a plan. I was looking at this the other day, and it says we are at a current annual inflation remains at a near 13-year high.
And that really speaks to 2021.
Yeah.
Right. Over the last decade, inflation on average has been about 2%, including inflation from 2020 to 2021.
They said the last one at our quickest pace was 2008. So yeah, it's been over a decade.
And so historically, inflation has been about 3%. But for over a decade now, we've seen inflation near 2%.
Right, lower than that.
And medical expenses tend to inflate at a little bit higher pace. So I think taking a conservative approach on inflation and planning for the rising cost of goods and services is really important, because if you don't, you can expect your lifestyle to degrade over time, because the amount of income you have coming into the household throughout retirement, if you don't adjust for inflation, you're going to have fewer goods and services that your dollar can purchase. And so it's extremely important that any written retirement plan, somebody's drafting a written retirement plan, how am I going to use all of my retirement resources, both income like Social Security and pension if you're fortunate enough to have one, and my retirement assets. If you're going to organize that and put a plan in place, a written outline of how to distribute and coordinate these assets in order to maintain your lifestyle adjusted for taxes and inflation, you must take into account the rising cost of goods and services, not just your basic goods and services like groceries and things like that, but also healthcare, because it tends to rise at a more rapid pace, and failure to do so will just result in a reduced lifestyle each decade that passes.
Absolutely. It's funny because you get yourself thinking, it's like, I remember when, gas used to be 68 cents a gallon. I remember when, you get a loaf of bread for 60 cents, and it's like, it really has an impact on it. That's in your working years. So you got to plan on that in your retirement years as well.
Well, before we move on from this too, I just want to throw out there, I've coached advisors for almost 2 decades now. And I've seen over and again failure to plan for inflation, where a client will tell them, well, I need $6,000 to live off of. Okay. And that's basically what the client has done some mental gymnastics in their head and determined that's what they're spending on a monthly basis. They failed to account for taxes and inflation and healthcare, which we'll get into in a moment. But just take that $6,000 of monthly income, and the advisor will say, okay, great. Well, we'll set you up with this income stream for $6,000 a month. Well, by the time we get 10 years out, that $6,000 doesn't buy as much. No. By the time we get 20 years out, we can buy
trouble,
a little over half
Yeah.
of the goods and services
Yep.
that it could 20 years ago. So you just can't ignore this one.
No, I agree. It's a big one. Last one we're going to touch base here, Mark, is healthcare and long-term care spending, which is, it's a biggie as well. Just a few of the numbers I pulled up the other day. Health spending totaled $74 billion in 1970. By 2000, it reached $1.4 trillion. By 2019, it's doubled to $3.8 trillion. That number is obviously on the rise, and when we do the planning on that, we talked about inflation. We do add 5% to that expense. That number seems to be on the rise, and it doesn't seem to be putting on the brakes anytime soon.
And most folks in the U.S. are going to transition at some point from either health insurance provided by their employer, or if they're self-employed, they maybe have their own plan, individual plan. They're going to transition to Medicare.
Right.
And Medicare Part A is free for folks who have enough work history and quarters that they paid into the program. For most folks, Medicare Part B, they're going to be paying a monthly premium for. And if their income, adjusted gross income, actually modified adjusted gross income, reaches a certain limit, they can end up paying income-related monthly adjustment amounts, or IRMA, basically a surcharge, a tax on high-income earners in retirement. But those premiums for Medicare Part B don't account for, under the current law, vision, dental, hearing. Those things are not covered by Medicare. So those, if you wear glasses, if you value your teeth or dental work, if you need hearing aids or something like that, those are all additional expenses that you're going to have to pay out of pocket. Now there's some supplemental programs, supplemental insurance, things like that you can buy. And, we outsource that to an expert on our team that handles all of that stuff, but those all add up. So we tend to plan for the average folks that we serve. We tend to plan for about $350 to $400 per month of medical spending per person. So if we have a couple, we're looking at closer to somewhere around 700 to 900 in that range per month, which oftentimes is less than what they were spending from if they had a healthcare plan provided by the employer. But not always.
No, not
sometimes
always.
it's pretty close, or maybe even not a reduction really at all. So and you have to adjust that for inflation, typically at a higher rate of inflation than other goods and services. Now, health insurance and retirement doesn't just mean medical care; it can also mean long-term care.
Exactly. Long-term care too. It's growing like the healthcare, really. When you look at the numbers here. Every day until 2030, 10,000 baby boomers will turn 65. 7 out of 10 are going to need long-term care at some point.
And long-term care is an event. It's not insurance. We always make that point when we're talking to prospective clients or clients. Long-term care is an event in which you need the assistance of somebody else to perform at least 2 of the 6 activities of daily living, or you have cognitive impairment. Okay. And that long-term care event could last weeks, months, years. And so long-term care event doesn't necessarily mean nursing home.
Right, which is a lot of people think. I'm not going to a nursing home. You can, they always have this exit strategy of pushing you off a dock or something. But it's not necessarily a nursing home. It can be the assisted living. It can be a short-term stay. You have a hip replacement or a knee replacement. Sometimes you got to go to these facilities just to recover, and then you get back home.
Precisely. And I think it's according to the federal government, the 80% of the care is delivered in-home or assisted living. Only about 20% of the care is actually delivered in nursing home. And so most folks that have a long-term care event are probably going to end up having that care delivered in their home or assisted living facility. And from a planning perspective, we can do one of 3 things. We can plan to transfer all of that risk to an insurance company. That's where long-term care insurance comes in. Transfer all of that risk to an insurance company. We could transfer some of the risk, knowing that 80% is delivered in home or assisted living, plan to cover that particular part of the risk. and not worry about the nursing home part. Or we could transfer none of the risk, take it all as the client, take all that risk on yourself and just basically hope that you're the 30% that never has a long-term care.
Yeah.
Right. And those are the choices. There's trade-offs for each one of those. And those are the choices that we try to guide folks through when it comes to mitigating this particular risk. So we've covered 6 common retirement risks that we see in our office on a routine basis that we help clients try to navigate and make decisions on those trade-offs, on how to either mitigate or eliminate those risks, at least the ones that we can mitigate and the ones that we can eliminate, and then try to put a course of action to help them succeed. So
absolutely.
That's it for this week's podcast. We hope you found it informative. If you have questions about any of these 6 risks, feel free to reach out to our office at www.triplett-westendorf.com, or you can call our office. The website will have the phone number there, and we look forward to catching up with you next time. Until next time, I'm your host, Mark Triplett.
And I am Troy Westendorf.
We want to make sure that you are striving to retire with purpose
and on time.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.